Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I am going to talk about the reason why I think people lose money selling covered calls. And this video is kind of a response to another video that I watched. One of the members of my option trading group did a video on a covered call that he sold on the SPY, the SPY. This is the SPY. It's an ETF on the S&P market, and he sold his call option at the $280 strike price, and the SPY at the time was trading at around $275. And I don't remember what day he did the video, but I'm going to take a guess that he did the video right around this part right here, because that's about the 275 level over here, and he sold his call option up here, and he said because support's up there, and he said in the video he got about $90 in premium. And then in the next couple of days the market went down like this, and right around here when the market went down to $270 he bought to close his call option for $15, and so he was going on about how much money he makes selling covered calls. So I gave him a little reply in his video, and I said, if this is true and you are selling covered calls, then you are losing money. And the reason why he's losing money is because even though he made $90 or whatever, the SPY went down here. He was actually in the red $500. So, you know, congratulations, he made $75, sold the open for $90 and bought to close for $15. His stock is down $5 a share. And a covered call is when you sell to open a call option on a stock that you own 100 shares. So he made $75, but his stock is down $5. He's down $500. And so I sent him a little reply, and he replied back and he said, well, that's okay. I have devised a strategy for myself. I'm going to wait until the market goes back up like this, and then I'm going to sell covered calls again at my lower dollar cost average, probably $1 or $2 higher. And I replied back and I said, that's great that you have a strategy that you are going to ride through these losses and you're going to wait until the market comes up, but you, number one, you did not say that in the video. And number two, if there's a recession and the market goes down 50% like it's done twice in my lifetime, right here was the housing market crash, and right here was 9/11, and both of those times are 50%, how many years are you going to wait for the market to come back up before you can start selling covered calls again? And this gentleman replied to me and he said, you are correct, but I try to keep my videos short. I never know what to put in my video or not. And when he said that, I did not reply. I just let it go. But between you, me, and this microphone that I'm speaking into, that seems like kind of important information. I mean, if he was managing my money and he bought a bunch of shares of the SPY, and I woke up one morning to see that I'm in the red thousands of dollars, I wouldn't be thinking, oh boy, you know, look at all the money I made on a $100 covered call. You know, I'd be thinking, man, I'm down $10,000 or whatever. I'd be a little bit peeved, right? But this is what covered call traders do. They think that they're winning the game because they're making money on these call options that they're selling to open, these short call options. They make $100 or $200 or whatever, and they completely ignore the stock that they're selling. So hopefully after you watch this video, I am going to correct that thinking, and I'm going to explain the reason why I think so many covered call traders get this wrong. And are you ready? So here's the answer right here. Let me go back to SPY. Okay, the problem with the covered call strategy is the name covered call strategy. When we say covered call strategy, the reason why we say covered call is because when you sell to open a call option on a stock that you own, the value of your stock is covering the value of your call option. In other words, if you were just to sell to open a call option, let's take a look at the calls on this SPY. So let's go 11 days out, and right now today is December the 10th, Monday. The closing price was $264. Okay, and let's go out of the money a little bit. Let's go up $5 just like this gentleman did, and let's see what we could get. So here is the 270 call right there, and it looks like you get about $170. Okay, so normal person would sell a $270 covered call, expires in 11 days, he'd get $170, right? Sounds pretty good. Now, the reason why we say covered call is because, number one, if you are selling a covered call, then you own 100 shares of this spider, which means that the SPY is at $264 and some change. So that's $26,400 that you have plunked down into this. Okay, and that gives you the privilege of being able to sell to open this call option or any of these call options, and the value, your $26,400, is covering any losses that you would take on this call option if you didn't own it. Because if you were to sell to open this $270 call option and you didn't own this SPY, then what could happen is the market could go back up to, let's say, all the way to 280, right? It was just at 280 a week ago, right? So if it went all the way to 280, then you would make this $170, but you would lose $1,000 of intrinsic value, and you would take a $1,000 loss minus the 170. You'd be down, what, $830. And the reason why that is because call options are contracts to buy stocks at set prices. In this case, it'd be $270. So if you make the choice to sell to open a 270 call option, then there's an option buyer buying that contract from you. And if the SPY went all the way up to $280, then what could happen and what will happen is that option buyer will say, guess what, Mark Jackson, I've decided that I'm going to sell you 100 shares of SPY at $270 a share, and I am obligated. I don't have a choice. That's the difference between option seller and an option buyer. The buyer has the right to buy, the seller has the obligation to buy. Now, here's what would happen. Okay, if the SPY went to 280, then that option buyer would say, I've decided that I'm going to use my call option, I'm going to exercise my right, and I'm going to buy 100 shares of SPY from you at $270 a share. So you are obligated to sell him, because he's buying the shares from you. You have to sell him 100 shares of SPY at $270 a share. Now, SPY is worth $280 a share. You'd love to sell it for $280 a share, but guess what you did? You sold a call option to an option buyer somewhere. So you would take a $10 loss, a $10 share loss, right? And that would be a $1,000 in the red loss. Now, you did receive some money for that. You got $170, but you'd still be down $830. That's what would happen if you sold to open a call option on a stock that you did not own. That's called a uncovered call or a naked call. So naturally, some genius out there said, I'll tell you what, we'll solve this problem. I'll create a new strategy, and we'll call it the covered call strategy. And from now on, what I'll do is we will sell to open call options, and we will buy the stock that we sell the calls. That way, if we buy this SPY at $264, and now if it goes up to $280 now, because we own 100 shares, yeah, we lose $1,000 on the call, but we're making we're making $16, right? 264 to 280. That's a $16 increase in the stock. So, okay, lose $1,000, but make $1,600, and that's why people like selling covered calls. But that, ironically, is the reason why people lose money selling covered calls, because the name covered call, if you watch my videos, what is the definition of an investment that covers any losses of another investment? What word do we use to describe when one investment lowers the financial risk of another investment? If you watch my videos, you know that the answer is called a hedge. Okay, the definition of a hedge is an investment that lowers the financial risk of another investment. And let me go ahead and Google search that and put in hedge like this. And let me go down to Investopedia. And here you go. What is a hedge? A hedge is an investment to reduce the risk of adverse price movements in an asset, right? In this case, it would be the call option that you are shorting. Okay, so let me close out of that. So, if you sell to open this covered call at $280, or I'm sorry, at $270, then you're trying to make $170 in profit, and then your covered call, your stock that is covering it, is the hedge. Okay, but when you sell a covered call, you're not thinking hedge, you're thinking income. And so that's backwards thinking, right? But when you look at this objectively, what are you really doing? You're trying to make $170 in the next 11 days, and you're buying the SPY at $264 a share. Okay, so you're risking $26,400.70 to try to make a measly $170. Now, any day trader will tell you that you are insane to take that kind of a risk-reward ratio. Any decent trader would tell you, you know, that I'm going to try to make $100 and risk $50, or even as much as favorable of risk reward as I can get. Maybe I'll risk $100 and try to make $500. Nobody would say I'm going to risk $26,400 to try to make $170 in 11 days. That's insanity, right? But guess what people do? People sell covered calls on a regular basis, and they say I'm going to sell out of the money covered calls, and I'm going to make a monthly income month after month. Okay, and this gentleman who did the video told me, well, the S&P will never go bankrupt. And that's great. But it could go down 50%. It's done it twice. Or it could go down a little bit, like what happened to him. Okay? He sold a $280 covered call, got $90. He owned the stock at $275, and it went down to $270. So he lost $500, but he made $70. Whoop-de-doo. How is that winning the game? So to correct your thinking, to correct this mistake that, and I'm not saying you, to correct this mistake that people in general make when selling covered calls, you got to stop thinking about covered calls as income. Start correctly thinking about what you're really doing when you are selling a covered call. When you are selling a covered call, you are investing in a short call, and you are buying the stock, and you are going long on the stock, right? And so what you should be thinking is that your call should be hedging your stock. And ironically, you should think covered stock strategy, but we never say that. There is no such thing as a covered stock strategy. I Google searched this and I put in covered stock strategy and nothing came up. Let's watch. If I put in covered stock strategy, then it comes up covered calls. Or a neutral strategy, which actually they're not. Covered calls are a bullish strategy. It's a conservative strategy, but it's a bull strategy. It's not a neutral strategy. And as I go down, there's nothing on covered stock, right? There's a ton of stuff on covered calls, right? And that's the problem, okay? Because when you cover a call with the value of a stock, what you're really doing is you are hedging. You're a hedger. But you don't think that. You think income. I'm going to make this income on selling these covered calls. And that's what's wrong, because when you think income, then you are taking this ridiculous amount of risk, you know, $26,000 to try to make $100 on a call option is ridiculous, right? And that's the reason why you will lose money. If you use this kind of mindset on a regular basis, you will take losses in the long run. There's no, you have no chance of getting ahead unless you have some kind of magic chart pattern system where you know the 3 simple chart patterns. I don't, and I don't think anybody else does. I think that's all horoscope, astrology stuff. Chart patterns are good roadmaps. They kind of tell you what the stock's been doing, and they give you an idea of what the stock might do, but there's no crystal balls, there's no guarantees. Past performance does not guarantee future results. How many times have you seen those commercials on TV, right? So to correct your mindset, don't think I'm going to make an income on the cover calls. You got to think hedge, okay? And now, how much sense does it make to hedge a call option to try to make $90 in a few days, and you're going to put in $27,000? It makes 0 sense, does it? Right? So correct your thinking and start saying, instead of me trying to hedge my call option, my short call, maybe what I should really be doing is trying to hedge this stock that I own, this $26,470 that I got plunked down into the SPY. Okay, now we're talking. Now you actually have a chance of making some money if you can protect all of this money, right? And you can do that by selling calls, and there are other ways to hedge this. You can buy put options, you can sell credit spreads. There are other ways that you can hedge this. There are also inverse ETFs, right? That's another way that you can hedge. And this is a little bit off topic because inverse ETFs have nothing to do with stock options, but I might as well throw this out there. ETF list, and let me pull this up. Want, short, or ETF? Let's try this. Let's see what I come up with. I hope it works here. Nope, that didn't work. Let me try one more. Where are you? What are the best? Here are a list of popular. Okay, let's look at this one. Okay, here we go. Ignore this big purple bunch of nonsense on an iPhone. Right down here are a bunch of inverse ETFs, okay? And so let's look for something on the S&P. Let's see. Dust, that's the one I do on gold. Where's one on the S&P? There's a whole bunch of them, aren't there? Here we go. Direction Daily S&P Biotech. So those are tech stocks, but that's what the S&P is. LABD. So let's look that one up. LABD. Let me close out of that. Let me go back to my Ameritrade. LABD. Let's put that in. ABD. Like that. And let's pull up a chart. And this is an inverse ETF on the what does it say? Biotech bear. That means that when this goes down, when the market goes down, this will go up. So let me pull up a chart here. So there you go. So you see the downward direction there. Let me pull up 5-year chart. You see how it's just been going down. You know why this has been tanking? The reason why this has been tanking is because it is a bear. It's actually 3x. I don't know that I'd even fool around with the 3x, but the reason why this has been going down is because when I put in SPY like this and I pull up the SPY chart, this has been going up. So this is not an inverse ETF. This is a regular ETF. The other one was an inverse ETF. So that's another way you can hedge. You can put some money in here and you can put some other money in the inverse. Okay, that's another way of hedging. But the point of a hedge is an investment that lowers the risk of another investment. Okay, so with the covered calls, right, what you should be thinking is, how do I hedge $26,400? Don't be thinking, how do I hedge a short call that's going to make me $90 in a week? Okay, that's the wrong kind of thinking. You got to think, how do I hedge this? You do that, you correct your thinking on that, and your money losing days will come to an end. Okay, yeah, you'll lose money a little bit sometimes, but you won't take the big gargantuan losses that this gentleman is going to take if he continues to sell covered calls and we hit that recession. He is going to lose a lot of money, and I don't know what he's going to say in his next video when that happens. But you correct that thinking, and you correctly stop thinking of trying to cover your calls. Start trying to think of, how do I cover my stock? How do I cover $26,400 instead of trying to think, how do I cover a $280 call option that I made $90. You do that, you correct your thinking, stop thinking cover calls, stop thinking I'm going to sell call options for income, start thinking maybe I should be selling those calls to hedge my stock. Okay, you do that and you'll start to make better choices. And what I would do if I was going to sell cover calls on the SPY is I would look at support. I wouldn't, let me clear all this out, I would not be looking at resistance way up here. I'd be looking to sell at support down here. Okay, now we're talking. Now let's look at how much money I would make if I sold a $260 cover call. Okay, so let's go back to in the monies like that, and let's look at the $260 cover call. Let's go to 11 days like this, and let's see what I would get for 11 days. So here you go. Looks like the bid is 707, the ask is 723. These calls expire in 11 days, so let's say we get it for 710. Okay, so 260 plus 710, that's $267.10. And let's do a little math here. So 267 minus 264 and 7, that's $300. I will make $300 in the time value of my call option if I sell a $260 in the money cover call. And now I'm giving myself a semi-decent hedge. At least if the market did go down $500, I wouldn't lose anything. I'd still make some money. Imagine that. Okay, if the market goes down $5, then my $264 stock would be worth $259. So I would take a $500 loss. But because, let's see, 264 minus 259, yeah, that's $5. So I would lose $500, but because I sold an in the money covered calls, I lose that $5, but I took in $710. So I'd actually make a $200 profit, right? That's how you sell covered calls. Okay, you should be thinking of hedging this. Don't be thinking of hedging the call. That's how I would do it. When I sell cover calls, I look at support. I look at selling cover calls down there. I don't look at selling cover calls up there because I think that's ridiculous. Okay, it's too easy to lose money, and that's what happened to my friend in the option trading group on Facebook. And so I decided to go ahead and do this video. And I'm not embarrassing anybody. I'm not saying his name. I'm not going to post his video or anything. I'm doing this nice and anonymous on YouTube on my lovely little channel. So I hope you enjoyed this video. I hope I've given you some good ideas on how to better safely invest your money buying and selling options. And if you want to do covered calls, go ahead and do covered calls. I personally prefer to do calendar call spreads. Calendar call spreads, you're buying the calls instead of buying the shares. To me, it's much better to spend a few $100s for a call than to spend several $1,000s for the shares. That's what I like to do. If you have any questions or comments, feel free to leave in the video section, in the comment section. And I hope you enjoyed the video. You will get, if you watch my videos, you'll get at least one video a week. You'll get more videos on days like today when I watch another video and I get an idea. But you will get at least that one video a week because I like to sell weekly calls and puts. And every Friday or Thursday I am buying those back. I'm closing those out for $1 or $2 or whatever, and I'm opening new ones, and I'm slowly making my money, $30, $40 a week. That's the way I like to do it. But you can sell cover calls. There's nothing wrong with selling cover calls if you do it correctly and you have correct thinking about your cover call strategy. So that's it for this video. Thank you for watching, and I will see you in the next one.